Part C. Pump House Limited is a resident company with a December year end. Pump House manufactures beers and ciders, which it sells both in South Africa, which are local sales, and in the United Kingdom, so export sales. Okay, so they do some manufacturing, be aware of that. They also do some export sales. Now, remember, from a VAT perspective, that is zero rated, but it's still a taxable supply, remember? Pump House also owns a variety of properties which it lets out. Okay, so now you should start being a little bit cautious. Pump House had originally started purchasing guest houses where guests could stay for short periods of time. It would give each guest a complimentary 6-pack of beers or ciders as a way to promote the brewing business. Pump House soon realized that it owned properties in areas where it could generate significant rental income from tenants if it constructed flats or apartments. And for the last 10 years, Pump House has retained its guest houses and has hundreds of flats in Gauteng and the Western Cape, which it lets out to tenants. Okay, so guest houses is commercial accommodation. And that is taxable. The flats or the apartments, residential accommodation, and we know that that is exempt. Section 12C. Pump House is a registered Category C VAT vendor, Category C monthly VAT returns. SARS has accepted the following percentages as a basis of apportionment in terms of Section 17(1) of the VAT Act. Okay, very important. So the local sales, taxable. Export sales, taxable. So local sales 15%, export sales 0%. Flats, exempt. Guest houses, taxable at 15%. So 25%. So this is 75% taxable, 25% exempt. Super important. And I expect that all of you probably saw that immediately. Then, the financial accountant has provided you with the following draft calculation of profit before tax and with the information contained in the accompanying notes below. Okay, sales of 9.7 million, consisting of local sales and export sales, and there's a note number 1. Let's go see note number 1. The financial accountant has provided you with a summary of the total sales revenue generated each quarter for local and export sales. Okay, so we've got local sales and we've got export sales. Now what do you see here immediately? VAT, look here, export sales. This should be 0 rated. So how much did they include? 2671590, which you can see is the amount excluding VAT. So this must be added to gross income because we should be taxed on this. Okay, then we've got rental income from the flats and the guest houses. Fine, gives us total revenue. Then we've got some cost of sales, that's for these beers and things. Then we've got a forex loss, note number 2. Pump House imported 10 specialized fermentation tanks from a supplier in the USA. Pump House would use this to manufacture, so it's manufacturing assets, a new type of cider. Pump House placed an order on the 15th of July 2019 to purchase the tanks at a cost of $1,500 per tank. The tanks were shipped FOB on the 1st of August. Right, so this is our transaction date, but also note that this is in the 2019 year. And they arrived on the 21st of August after paying the necessary VAT and import custom duties of 150,000. Alright, so that 150,000, that's the customs duties. right, that'll be added to cost. And sorry guys, if it's a bit vague here, after paying the necessary VAT, that's not the amount. The import and customs duties are 150,000. So sorry, if you thought it had to do with the VAT, I do apologize, it could be a bit vague there perhaps. Then, Pump House was concerned about the fluctuating exchange rate, and it took out a 6-month FEC on the 1st of August, which is the same date over there, to cover the debt. The FEC would be settled on the 31st of January 2020. Okay, that's important. So that is a settlement date, or a realization date rather. And important, that's the 2020 year. And this is the FEC rate. Pump House could not immediately use the fermentation tanks and only brought them into use on the 31st of January 2020, so the 2020 year. Now that's super important because right, if that's the 31st of December 2019, the transaction date is here, but only brought into use here. Sorry, brought into use. So that means section 24I7 will apply. All the 2019 Forex gains or losses taken into account in 2020 when asset brought into use. Now you guys should all know that. So you calculate it as normal in 2019, but you only bring it into account in the 2020 year. The fermentation tanks have a useful life of 4 years per interpretation note 47, and the management of Pump House agrees with this estimate. The financial accountant posted the following journal entry based on the payments made on the 31st of January 2020. This is the only journal entry that has been processed in respect of the fermentation tanks. Right, now these fermentation tanks, we give you section 11E here. But you need to remember that this is a manufacturing asset. So therefore, we will use section 12C. All right. The financial accountant posted the following journal entry based on the payment made on the 31st of January 2020. This is the only journal entry that has been processed in respect of the fermentation tanks. So they debited property, plant and equipment with 1,500 times 10 times 16 rands 50. 16 rands 50 is the exchange rate on the 15th of July 2019. That's when we placed the order. That's incorrect. The Forex, then there's a Forex loss, which is a balancing figure at the bank, which is 16 rands 85. 16 rands 85 is what we are paying. Sorry, that's way too far. For the FEC. So the difference between the date when we placed the order and the date we actually settled the FEC, that's the Forex loss that this accountant has calculated. That is definitely wrong. It's wrong for accounting, it's also wrong for tax. Definitely. So we'll have to add it back. Because remember, they've deducted it here. So let's just quickly go here. The 1st of August over here. This is transaction date. The 31st of December 2019 is the translation date. And the 31st of January the realization. Right, so those are the important dates. So that's an important date, that's an important date, that's an important date. And then for the FEC, a 6-month FEC was taken out on the 1st of August. There you can see that rate. On the 31st of December, August, September, October, November, December, 5 months have passed, so there's 1 month left. So that is what we'll use for the FEC. Okay. Then next up, depreciation of 2.510 million. The financial accountant has provided you with the fixed asset register. Okay, there's some manufacturing assets, factory buildings, guest houses, flats, notes A, B, C, D. Note A, manufacturing assets. The manufacturing assets were all purchased in 2000 and were depreciated over a period of 10 years. The equipment has proved resilient and is still being used by the company. So we'd use Section 12C for this, but Section 12C is 40, 20, 20, 20, which is 1, 2, 3, 4 years. This was already purchased in 2000. Okay, so you can see it's fully written off. Now, also just to note is that these fermentation tanks should be included there, but remember they told you the accountant has not processed anything of that. Right, I don't know why it's not shown there. Okay, factory buildings. The factory buildings were acquired in 1999, depreciated over a period of 20 years. Section 13 is 5% per year, so that's 20 years. So in the year 2011, this was fully written off. Guest houses. The guest houses were purchased in 2000 and is being depreciated over a period of 20 years. Right. %. Section 13.6. And then the flats. The amounts shown for flats in the fixed asset register relate to all flats purchased prior to the 2020 year. The company purchased new building consisting of 30 flats for a cost of 18 million excluding VAT that were let out from the 1st of July. The company has not included this new block of flats in the fixed asset register and has not yet calculated depreciation. Right, so we still have to do this. Section 13.6. Sorry, this guest house over here, Section 13 Quinn. It's a commercial building. Right, then there's profit on disposal of an asset, 5,000 rands. Note number 4. The company purchased a mainframe computer for the accounting department on the 1st of October 2018 at a cost of 69,000 and brought it into use immediately. This is the 2018 year. This is for the accounting department. They give you the amount including VAT, and I'm going to remind you, remember, can only claim 75% because you're a 75% vendor. Unfortunately, the computer did not meet the needs of the company, and in 2020 the decision was reached to dispose of the computer and was sold for 47,000 on the 1st of April 2020. The computer was not reflected in the fixed asset register and no depreciation has been calculated, and it has a useful life of 5 years. Alright, that's it guys. So in the next recordings I'll start with the required. Question 1 and 2 we've answered a lot of it already, but I'm going to start with those two and then I'll do question 3 where we'll actually work through it.